So yeah, this is day 5 of the series, and today we'll be covering 1.8 outline of the text. So this is the last part of the first chapter, the investment environment, and in this 1.8 we'll be just reading about the outline of the entire book and the different parts that it has, and then we'll be going over the summary, and that'll be it for today. And then tomorrow we will start with the problem sets which are here. So this video will be very short, like 15 minutes or something. So yeah, anyways, the text has 7 parts which are fairly independent and may be studied in a variety of sequences. Part 1 is an introduction to financial markets, instruments, and trading of securities. This part also describes the mutual fund industry. Part 2 and 3 contain the core of what has come to be known as modern portfolio theory. We start in part 2 with a general discussion of risk and return and the lessons of capital market history. We then focus more closely on how to describe investors, risk preferences, and progress to asset allocation, efficient diversification, and portfolio optimization. In part 3, we investigate the implications of portfolio theory for the equilibrium relationship between risk and return. We introduce the capital asset pricing model, its implementation using index models, and more advanced models of risk and return. This part also treats the efficient market hypothesis, as well as behavioral critiques of theories based on investor rationality, and closes with a chapter on empirical evidence concerning security returns. Parts 4 through 6 cover security analysis and valuation. Part 4 is devoted to debt markets and Part 5 to equity markets. Part 6 covers derivative assets such as options and futures contracts. Part 7 is an introduction to active investment management. It shows how different investors' objectives and constraints can lead to a variety of investment policies. This part discusses the role of active management in nearly efficient markets and considers how one should evaluate the performance of managers who pursue active strategies. It also shows how the principles of portfolio construction can be extended to the international setting and examines the hedge fund industry. So that was 1.8. We are now officially done with the first chapter, and I'm very happy that I could finish. This is a good point. And now we'll move on to the summary. Summary is first point: real assets create wealth. Financial assets represent claims to parts or all of that wealth. Financial assets determine how the ownership of real assets is distributed among investors. Financial assets can be categorized as fixed income, equity, or derivative instruments. Top-down portfolio construction techniques start with the asset allocation decision, the allocation of funds across broad asset classes, and then progress to more specific security selection decisions. Third point, competition in financial markets leads to a risk-return trade-off in which securities that offer higher expected rates of return also impose greater risks on investors. The presence of risk, however, implies that actual returns can differ considerably from expected returns at the beginning of the investment period. Competition among security analysts also promotes financial markets that are nearly informationally efficient, meaning that prices reflect all available information concerning the value of the security. Passive investment strategies may make sense in nearly efficient markets. Financial intermediaries pool investor funds and invest them. Their services are in demand because small investors cannot efficiently gather information, diversify, and monitor portfolios. The financial intermediary sells its own securities to small investors. The intermediary invests the funds thus raised, uses the proceeds to pay back the small investors, and profits from the difference, the spread. Part 5.5, investment banking brings efficiency to corporate fundraising. Investment bankers develop expertise in pricing new issues and in marketing them to investors. By the end of 2008, all the major standalone US investment banks had been absorbed into commercial banks or had recognized themselves into bank holding companies. In Europe, where universal banking had never been prohibited, large banks had long maintained both commercial and investment banking divisions. Sixth point, the financial crisis of 2008 showed the importance of systemic risk. Systemic risk can be limited by transparency that allows traders and investors to assess the risk of their counterparties. Capital requirements to prevent trading participants from being brought down by potential losses. Frequent settlement of gains or losses to prevent losses from accumulating beyond an institution's ability to bear them. Incentives to discourage excessive risk taking, and accurate and unbiased analysis by those charged with evaluating security risk. Key terms are investment, real assets, financial assets, fixed income, debt securities, equity, derivative securities, agency problem, asset allocation, security selection, security analysis, risk return trade off, passive management, active management, financial intermediaries, investment companies, investment bankers, primary market, secondary market, VC, venture capital, private equity, securitization, systemic risk. So that was the summary and the key terms done. So we'll actually call it for today because I have a micro exam tomorrow, microeconomic theory, and I want to start the problem sets in a fresh video, and I'll do that probably tomorrow only after my exam. So yeah, hopefully my exam tomorrow doesn't go too bad, and yeah, thanks for watching.